Hello, my friend. It's the Crypto Lunatic live from the Lunar Café, bringing you hidden gems before they pop and simplifying the language of crypto for newcomers to the space. And today we're going to answer the question, why do 84% of retail traders lose money in crypto? 84%, folks, 84. So we're going to explore the psychology of why people lose money in crypto and what is the difference between those that lose money and those that make it. This is going to be a view from three independent AI engines asking the same questions. And they're two very simple questions. What percentage of people new to crypto in retail lose money? And what is the difference between those that lose money and those that make them? So I've got my own slant on it. And quite frankly, it's not much different to what AI has come out with. But I just wanted to explore that with you today. The simple question. I talk a lot about the coins and how much money you could make and getting into these degen coins. Now, there's a couple of things that you need to know about this channel. The first thing is I talk about degen coins because there's a demand for people to know about degen coins. Degen coins are massively high risk. And the percentages state that at least 8 out of 10 degen coins will go to nothing. At least 8 out of 10 of them. It's a high risk game. And my friends, you need to understand this. The VC mindset, venture capitalists, when they invest in startups, they expect 8 out of 10 businesses to go bankrupt. It's a game that they're trying to find the one that makes all of the other investments seem worthwhile. That's the game in crypto if you're in the degen game. But that's a completely separate path to those who buy Bitcoin on a dollar cost average and they buy and they hold. And this is what we're going to explore today. I'm going to take you through that lens of the AI engines to educate you into a little journey into why do retail traders lose? So this is the first question. What percentage of retail traders lose money in crypto? So retail traders in cryptocurrency, typically in individual investors using exchanges like Binance or Coinbase, face high risks due to market volatility, leverage options, and speculative nature. Whilst exact figures vary study by study methodology and time frame, the consensus for academic research, broker disclosures, and surveys is 70 to 95% of retail traders lose money overall. This range reflects differences between long-term holders who fare better and active traders who often fare worse. So let's look at some of the factors, the key studies and statistics. So you can look at the percentages here, my friends. The percentages here are alarming. Look, day trading, 95 to 97% of people losing money from retail. It is shocking, my friends, absolutely shocking. So let's look. This is Grok. Why do so many retail traders lose money? Speculative entry and momentum chasing. So many people, they decide to go in when the price is shooting up. This is the wrong time to go in, my friends. And if you follow this channel, you'll know this. The point is to get into cryptos when no one's talking about them, when they're price suppressed. A lack of strategy and education. Listening to the wrong influencers is a big part of this, my friends. Fees and leverage. So leverage is the enemy of the retail trader. You see 500x leverage, and all they think about is how much money we could make, not how much money you could lose and how quickly you can lose it. Leverage will waste retail traders, absolutely lay them to waste. And market manipulation. So whales and institutions are never going to pay big leverage trades. They're going to flush them out of the market as sure as the sun rises, my friends. Very few people are going to make money with heavy leverage. That is the truth. And a day trading bias. So caveats, traders versus investors. The 70 to 95% applies more to active traders. Long-term Bitcoin holders, dollar cost averaging, see lower loss rates. Time frame matters. So this is probably the most important thing. So many people overestimate what they can make in the next couple of months and underestimate what they can make in the next couple of years through buying and holding. And this is a massive factor. Data limitations. So most studies focus on Bitcoin or app users. Altcoin traders likely fare worse, and regional variations. So in summary, while crypto offers high rewards potential, the data substantiates that around 80% of retail traders lose money, aligning with the patterns that other speculative markets. Success favors disciplined long-term strategies over frequent trading. Now, this single sentence could summarize the whole video. Let me read it again. Success favors disciplined long-term strategies over frequent trading. If trading small, start small, educate yourself, and use risk tools like stop losses. So, the next question, please highlight the key differences between those who make money in crypto and those that don't. So, the key differences between retail traders and those who make money and those who lose them stem from behavior, strategy, and market approach. Based on available data and patterns, here's a concise breakdown of what sets traders apart from unprofitable ones. So profitable traders favor long-term holding or hodling. They use disciplined strategies like dollar cost averaging. Now, the idea of dollar cost averaging, for those that don't understand what that is, it means that rather, if say you've got £100 to put into crypto and you put it all in one, dollar cost averaging would say we'll put $10 every week. That way, when the market is volatile, you'll catch the highs and the lows. So it will create an average. It means that you won't get in at a single point of failure, and you average out the risk of entry points. So dollar cost averaging is largely considered the most effective method of accumulation. Unprofitable traders engage in short-term trading or day trading with 95 to 97% losing money. They chase price spikes, hype, or fear of missing out, FOMO. So risk management, profitable traders use risk tools like stop losses. They avoid cautiously use leverage. They maintain a low percentage of capital per trade, 1 to 2% risk per position. Unprofitable traders. So they over leverage positions, amplifying losses. They lack the stop losses or risk patterns, leading to emotional panic selling during dips. Invest disproportionate amounts in single assets, risking total loss. So it's about education and discipline, market timing and behavior, and not entering hype cycles. So profitable traders minimize trading fees by using low-cost platforms. Now, this is important. Some platforms will rinse you with fees. Trading platforms always win, because whether you win or lose, they win because they charge a fee, and some charge more than others. And some are really, really expensive and will rinse you with the fees. So you have to bear this in mind, my friends. Know your platform and know the fees that you're paying. And final notes, data insight. Profitable traders are often the minority, aligning with patterns in Forex and stocks. Long-term holders fare better than active traders, hodlers. Practical takeaway, success in crypto trading requires education, a long-term perspective, disciplined risk management, and fee awareness. Avoid emotional trading and speculative altcoins. Tilt odds in your favor. So here we go. We asked the same question. This is perplexity. And this says 84 to 90% of people lose money. Key statistics, 84% of retail traders lose money in their first year. 58% of new traders lose nearly all of their investing capital in the first year. Now, this is frightening, folks. This is absolutely frightening. 58% of new traders lose nearly all of their invested capital in the first year. And the failure rate can reach as high as 90%, especially when counting all active and lapsed retail traders. Among those trading, leveraged crypto products, losses affect up to 89% of retail traders. Common causes of loss: poor research, lack of understanding, emotional decisions, trade chasing FOMO. Many traders engage in risky day trading tactics. The significant don't use stop loss. They don't use stop losses, my friends. So industry context, crypto trading platforms and exchanges often profit from high turnover and volatility that cause these retail losses, such as by charging fees, no matter what the outcome. Now, this again goes down to exchange fees. Know your exchange and know the fees that you're paying. In summary, more than 8 out of 10 crypto retail traders lose their money, and a number may even be higher depending on the trading method and market conditions. So the differences. So this is just likely to be the same as before. Strict risk management, stop losses, rely on well-defined trading plans, technical analysis through market research to guide buying and selling decisions. Emphasize emotional discipline. This is why you have planned. Know when you're going to get out. Have an exit plan. Not having an exit plan, it will absolutely rinse you in crypto. Set realistic expectations. Stop listening to the 100x growth and settle for 2 to 3x and then start taking profits. Things like that, or 5x. But lose this 100x nonsense, the 50x, and start taking profits when you hit something between 3 and 5x. Have a plan. Adapt to the flexibility of the market. So here's the common pitfalls. Overtrade and take too many positions without clear strategies. Ignore misuse risk management, exposing a large position of their capital to single trades. Make trades based on hype or poor research. Rarely track performance indicators. Lack of understanding of crypto fundamentals. Behavior and psychological differences. Winning traders maintain a trading journal to track not just trades, but emotional states. Trade emotional states, learning from both wins and losses. They stay patient through volatility, while losing traders tend to panic or revenge trade after losses. Now, this is a big one. You lose loads of money and then you throw in more money to try and offset the losses, just accumulating more losses. Your emotions spiral downwards, and that is the death spiral in trading, my friends. So successful individuals continually seek improvement and education. Unsuccessful ones often stagnate with the same mistakes. In summary, discipline, education, and robust risk management separate successful crypto traders from those who incur consistent losses. And finally, the same question to ChatGPT, and again, 84%. Important caveats: time frame matters. Active trading versus passive holding. So passive holding is the way, my friends. Dollar cost averaging, realized versus unrealized losses. So losses on paper until they're sold. So you haven't won or lost until you've exited the trade. So counting wins or losses before you've exited is a fool's errand, my friends. Survey bias and self-reporting. So many statistics come from surveys, which have their own limitations. Market conditions, bull versus bear. Bottom line estimate, putting it all together, somewhere between 70 and 90% of retail crypto traders lose money, especially over longer periods of when trading actively. So there you have it, my friends. Highlight the key differences. It's likely to be the same. Long-term mindset, risk management, thorough research, emotional discipline, understanding market cycles, low time preference. Learn from mistakes, avoid overtrading, and use cold storage. So this is important. Trading is brutal enough anyway, but losing access to your crypto is just an extra degree of brutal through not understanding wallets or exchange risks. So those who lose money, they chase pumps. They're over leveraged. They lack a plan. There's no risk management, impulse trading. They don't understand what they're buying. They panic and sell at a loss, and they ignore fundamentals and addicted to gambling. So there you have it, my friends. The key difference: winners treat crypto like investing. Losers treat it like gambling, which pretty much sums up this video. So in summary, that if you don't know what you're doing in crypto, or you're listening to influencers, you don't have a plan, you don't have stop losses in place, you're using leverage, you're buying into the hype, you're chasing in pumps, these are all things of why so many people lose money in crypto. And to summarize it succinctly, the people that win the most over time are those that dollar cost average into Bitcoin. If you want low risk in crypto, the lowest risk that there is to dollar cost average into Bitcoin and leave everything else alone, because that's just for the degens and the lunatics out there. Now, you can make a lot of money in an alt season if you do know what you're doing, but most people don't. Most retail don't, and most retail are listening to the wrong influencers, giving them the wrong information for the wrong reason, my friends. Which is why when regulation comes into crypto influencers, there's going to be a lot of people in a lot of trouble, my friends. A lot of people in a lot of trouble. So, in order to keep myself out of trouble, I'm going to tell you that nothing that I say is financial advice. This is all about education. And the more education you have, the more awareness you have of the market, the more likely you are into being a very small percentage of people that actually come out winning. And I want you to win, my friends. I want you to win. And if you want to keep on winning and you want balanced educational content and more of it, and you've liked this video, then please do subscribe to the channel. And if you want another video, you'll find it just there. But either way, my friends, as I always say, stay lunatic, have fun, and make money in crypto.